Hi everyone. Thanks for joining us today. As we are starting September, Q4 approaching, an exciting time for everyone in the e-commerce space. And it's a pleasure to have some great speakers, great companies joining us today. So hopefully there's going to be a great knowledge fest that the guys are going to bring to the table, some amazing conversations we are intending to have, and hopefully a lot of value that we'll be able to bring and actionable advice that you guys can utilize in your own businesses. So firstly, we'll just do a round of introductions from the speakers that are here. On our side, my name is Go Singh. I'm the partnerships lead at Osome, and we're here next to discuss different topics in context of funding your business, in terms of selling your business, whichever is the right route for you. So Daniel, if you can give a quick introduction, please. Thanks.
Definitely great to meet you all, and thanks for all taking the time today to chat. My name is Daniel Roddick. I'm the head of market development at Clearco. We are the largest e-commerce investor in the world. We've deployed just over £2.1 billion across 5,500 founders, really all across North America, Europe, as well as some parts of APAC and Australia. And we really pride ourselves in being an investment firm built by founders for founders. Our investment product is entirely non-dilutive, and we can talk more about that later. And the for founders by founders part is, I'd say probably half of our team has started businesses before. So the short on my history is I've kind of the 10 years prior to joining Clearco, I built and sold a few businesses in the e-commerce space, exiting my last company in 2019. Have done it all, have bootstrapped, have raised venture debt, self-financed, and then today, outside of Clearco, I also do some personal angel investing as well. So excited to talk on any and all those topics, depending on what you guys want to hear about.
Brilliant. Thank you for that, Daniel. And yeah, I think especially with your experience as being a previous founder, that's definitely very interesting and something we'll draw upon later in the conversation. Alexei, if you can go next, please.
Hello, everyone, and thanks for joining this webinar. I'm excited about the today's session because it's like I think we have the unique mix of companies that can walk with you throughout the journey of like growing your e-commerce business, like up to the sale itself. So what will be great to hear this conversation. A few words about ourselves. Like I am looking after the UK business and the e-commerce business of Osome. Osome is the company that helps e-commerce sellers with all their admin tasks, starting from company incorporation, then accounting, bookkeeping, and tax filing. What we do basically, we will automate as much as possible of the manual work so that we make sure that data consolidation is being done automatically, and the preparation of financial statements, reconciliation, and bookkeeping is also done automatically with the help of accountants that are working with us. So we're not just a software; we are providing the full scope of like accounting, bookkeeping services end to end. So with us, I believe Osome is like the unique value proposition for the e-commerce businesses on the market, providing the full scope of accounting and bookkeeping services. Thank you.
Thank you for that, Alexei. And yeah, adding to that is we are operational across UK, Europe, and Asia. So we will cover various territories through Osome. And then Jim, if you can go next, please.
Sure. Hi, Gal. Hi, guys. So a bit like Daniel, actually, I bootstrapped myself an Amazon FBA brand in 2013. Got up to mod 7 figures, raised capital, asked myself the question a million times: should I borrow? Should I sell? All the stuff we're going to talk about today. And then 2020, I made a big change. I joined Thrasio, where I'm now director of acquisitions, working out of London. So now I'm talking to, I'm not a seller, I'm an acquirer. So I'm having the same conversation, but through the lens of acquirer. Thrasio, we're 1,000 people now, over 140 acquisitions, got a really strong sort of operational pedigree around acquiring and growing the brands that we bring in-house. And our goal is very simple. We try and outperform the rest of the market, deliver great exits for our sellers. And as long as we keep delivering on that story, we keep raising huge amounts of cash, and 1.7 billion to date. And yeah, it's all grounded in having an operational base that's delivering or outperforming the market. So I hope can give quite a good perspective, both as seller and acquirer, around this conversation around when to sell, should I raise money, and what's the answer to some of the tricky questions that most entrepreneurs face daily.
Yeah, that's great. Thank you for that, Jim. So before we get into the agenda, I think just to kind of once again reiterate is we've got a great set of companies, and then guys, whichever dream you've got when it comes to selling a business, financing it, getting the right paperwork in order, the guys are here to help you across the event, after the event, and we're going to be running some polls, some questions. Please, where possible, do fill those in, because we can try and cover as many topics and keep it relevant to you guys. So that'll be much appreciated. Brilliant. Okay, so let's start with the first topic / question. When should you think about raising investment or selling your business? At what stage? So Daniel, do you want to take that first, please?
Yeah, so I think there's kind of two separate parts of it. And when I think about capitalizing the business, the first place I always start, in the same way I started with my first company, is how do you raise money from customers or through revenue? So I call it customer financing or revenue financing. That's a fancy term for, like, can you just make money without asking anyone else for money? And there's some different ways you can do it. So if you are a enterprise SaaS company or some software company, especially in the early days, there's lots of ways you can pre-sell contracts and pre-sell your software just to de-risk it for yourself as the founder of, like, is this actually really a thing? Because I think the worst thing you could do is invest 6 months a year building something that nobody wants. And the only way you know if someone wants it is they actually sign a contract and agree to pay you for it, and ideally pay you upfront for it. If you're an e-commerce company, there's a few other ways you can do it. For example, we have a partnership with Indiegogo. Kickstarter is another option. You can do it on your own. Can you actually just generate pre-sales before you have to commit to inventory, again, as a way to de-risk it and also generate cash flow for you? Or once you're in flight, can you do things like, for example, my first company was a subscription beauty box company, and we built the business or financed it by selling annual subscriptions. We got it up to about 52% of our subscriptions were annual subscriptions, which meant I got 12 months of cash upfront to finance all of our operations. And that's how we bootstrapped the business. That's the only way it really worked. And so I'd encourage you to explore that. Or if you're not a subscription-based business, I think you can look at things like doing deposits for drops. Like a Tesla is a very famous example. Even a company as well capitalized as them, you had to pay $1,000 or $5,000 to reserve a car. And they made a few $1 million on reservations before ever selling you a car. And lots of our portfolio companies do that as well. And so that's the customer financing side. And I'll say start there, because if you're making money, if you're profitable, raising money becomes infinitely easier because you have leverage. And so I think the way you can look at your different financing options is, I would think about equity capital as things that will help you take you from 0 to 1. So meaning you have an idea, you have some demand, and you need to start it. That's where angels, friends and family, or ventures are a very good fit. When you're kind of at scale and growing and have some traction, that's where a solution like Clearco can help on some parts, where if it's a repeatable expense, like a marketing investment or inventory, the return on that investment. Don't spend expensive equity on that. Use our form of capital or comparable revenue-based financing option to do that, and save equity for new products, team expansion, things like that. And Jim, I'd love your thoughts on the exit part, but in my perspective of how we approached it, really anytime you're thinking about raising a institutional round of capital, so you call it your seed, your Series A, your Series B, I would always recommend looking at it as a parallel path. And you'll find different buyers at different stages, but there are lots of buyers, especially today, that are able to buy businesses in the few $1 million revenue range. So you're never really too small to sell, even at this stage, especially now. And that just gives you optionality. So if you have one term sheet that says, here's what an equity investor will put into me, and you have another term sheet to say, here's what I will sell at, one, that gives you negotiating leverage, and two, that gives you personally options to decide what you want to do. So hopefully that's a concise picture of all of it, but there's a lot to talk about at each of those ideas.
Yeah, brilliant. I think there's naturally various ways, and very interesting as to how you were able to fund your own business previous to Clearco by charging annual subscription. So there's various ways. It's just about having a great product / service, making customers happy. Then alongside that, the sky's the limit, and one can be quite tactful as how they can raise funds. Jim, if you can share your perspective next, please.
Yeah, I mean, cash flow is the sort of make or the break of most businesses. I mean, especially in a high growth environment. So, I used to explain to my friends, if you have a business that's growing 30% a year and you make 30% margin, if you have one product doing 30% growth, you don't have any money to launch a new product, let alone pay yourself or build your team. So the only way to grow is to raise money or push the cash flow pressure onto your supply chain. And if you have relationships and volume building over time with your supply chain, you can push some of that onto your headache onto your suppliers. But at some point, if you're ambitious, you've built the foundations of a successful brand, you're probably going to end up raising money one way or another. Some businesses manage to just push it all on supply chain, but I think it'd be naive and unfair to say that's what everyone should do, because it's not a reality for most people.
Yeah, fair enough. And then in context to some of the things you mentioned, what are the key kind of indicators, when it might be specifically a good time to raise money, or is there such a thing as the right or wrong time to raise money or exit? As a follow-up question to you, Jim.
For me, look, when to raise money. I mean, fundamentally, if you've got a business on a great growth trajectory, the biggest handbrake on that growth is going to be cash flow. So the question around when is, as soon as you see that growth, that growth potential, the one thing that's going to frustrate you as an entrepreneur and business owner is that you can't deliver the potential of the business because you haven't got the cash to feed it. And you'll know when that moment comes. And it can happen in the first 6 months of starting a brand through, years into the business. But fundamentally, even the most successful growth businesses sometimes end out of business because they don't have the cash flow. They're not planning their cash flow effectively. It's not easy. So I don't think there's an easy way to say when, but most owners will know when the right time is for them. And then it's about what are the options available to them. And the market's matured a lot. I mean, I tried to raise money for an Amazon business in 2014, 15, and all that was available then was Amazon lending. Because you go and talk to a bank about an Amazon FBA business, they thought you were crazy. They just didn't get it. And then, some fintech entrepreneurs came along and went, hang on, this is an amazing category. And, funding started to come. But for the first few years, the only option was family, friends, or Amazon lending, which, they owned that space. So, we're lucky now. I think e-commerce has really developed in the last 3 years, and all of the service provision around that has grown with it, which gives sellers more options than they've ever had.
Yeah.
When you're talking about the options, I think it's like the interesting subject would be, do you see what are the options that are available at the moment, and that they were available by the time that you've been growing your own businesses, both like Daniel and Jim? So I guess one thing that we see in the UK is that if you are a business that started a few months ago, and even though you see the good growth rates on your Amazon store, you still will have a hard time finding the loan provider that will basically give you the loan. So it's probably as far as we understand, it's very hard to get the loan from the high street banks. There are now more and more solutions from new fintech companies. But what's your experience? Are there a lot of options available early in the career of the entrepreneur? I'm also looking at the poll we've done, and we see that a few of our listeners are in their between year 1 and year 3. So what do you think? What would be available for them?
I think Daniel's probably better placed to answer this than I am.
Yeah, I mean, I think you already touched on it, Jim, in that the earlier you go, the harder and harder it is to raise capital from traditional investors, especially for something like an Amazon FBA business, because an investor who's not familiar with the space won't understand the business, because it's oh, so you just sell this one SKU on Amazon, that seems like a casual part-time thing. It's not a serious business. I don't get it, because they're looking at it all qualitatively, and you can show them all your numbers and all your metrics. It won't matter oh, but that doesn't feel like if it's your equity investor, I don't understand what I'm backing with my equity dollars. And I think there's, the certain part of that I would say is correct, in that when you think about very, very traditional venture, we can take it a step aside for that world. The way a VC fund works is that ultimately they need each of their companies to have a chance at being able to return the fund. So what I mean by that is if you are raising venture capital from a $100 million fund, they have to have the belief that by putting a check into you, you alone for the $5 million, $10 million they give you could return $100 million for them. Because what happens in real life is that $100 million, let's say they put 10 investments at $10 million, $30 million is already written off because 3 companies will fail. So they're already down 70 million. The other 6 of the 7 maybe will return the capital back to the fund. And so, they've given you out 100, they've made back 60. So they need to make up another 40. So for them to break even, they need you to at least 4x your value, if not 10x your value, to actually make their investors happy. And so a lot of these great e-commerce companies are amazing businesses, but are not amazing for venture capital. The return profile just doesn't make any sense. So it's not a product market fit for a lot of these investors. When you think about banks, it's kind of the same situation. A lot of them will have very, very traditional looking at assets, looking at taking lean on assets. And if you just, if you're trying to run a lean operation where it's all just in time, all of that, you have no collateral to put up. And so ultimately, the only choice you'll have is to give up a personal guarantee or personal security. And so, again, it's all choices. There's nothing good or bad about any choice. But that's something for you to think about. Of the true downside scenario is, what is the expected chance that you think the business will fail? Multiply that by what is it you're putting up personally in security? Is that cost worth it to you? If so, then fine, I'd pursue that option. If not, fortunately, there's a lot of different options. Us being one example of it, where we simply evaluate you based on your revenue. You plug in your Amazon account, your Shopify account. We ingest the data. We look at it. We come back to an offer within 20 minutes to 24 hours, and we don't take any security. And so it's just meant to be. It's a product built to finance and capitalize these types of businesses. And then, our hope is with folks like, Jim's group at Thrasio, or, wherever else you choose to sell. I see about 50% or 60% of people are looking to sell. At that point, all you have to think about a founder is, how do I start hitting milestones to grow my business? And you'll understand, talking to anyone in the space, you'll know the multiples, you'll know roughly what you can sell for. And then you can kind of choose to pull that trigger when you want, assuming you're continuing to show growth and showing consistent unit economics and all of that. So it's kind of a long answer, but that's kind of my personal view on how to navigate fundraising.
While we are on it, with the Clerco, what is the earliest moment that entrepreneur can apply for your funding?
So we start quite early stage. So if a business is been trading for 6 months and has at least £10,000 in monthly turnover, we will have an investment for you, so long as you're a true e-commerce business. And it seems like 100% of people here are selling products and services online. So I suspect we would be able to invest in most, if not everyone on the call.
Great. Awesome. Yeah, that's great. Yeah, 6 months is something that I think that's still very hard on the market to get the funding for.
Brilliant. Thanks for your insight, guys. So we'll move on to the next topic. So what might be the key indicators when it comes to, before you sell or fundraise, when it comes to maximizing your company/asset value? So as Alexei Osome did a fundraiser, I suppose, of their own recently. Can you start on that topic first, please?
I guess with Osome is a little bit different because we are a SaaS company, right? We are a small business SaaS tool, and in SaaS world, as Daniel mentioned, that the way the fundraising is working is a little bit different compared to Amazon business, because the venture capital game is different, right? Like you need to show product market fit, you need to show product channel fit if we are talking about Series A. Right, and you need to show the opportunity for the investor that the market is there and the market is huge, and that the investors will be able to do 10x return on this investment. I think when we are talking about the e-commerce business, there can be two. One of the things that I can think about is as either Daniel or Jim already mentioned, is like when you look at the potential growth of your business, like the question you're asking is, okay, am I growing as quickly as I could possibly grow, right? Or the absence of cash is limiting my growth, right? So if you see that there is opportunity on the market to sell like twice more than what you're selling now, right? And the loans available or funding available will allow you to still have a good return on this investment. In addition to, like, if you bootstrap, for example, then yeah, that's pretty good point to raise more money and to accelerate your growth. Yeah.
Brilliant. Thanks for sharing that. And then Jim, if you can go next, as to, let's say, one were looking to be selling their business, what might be key indicators or things that they can do to maximize what they may be able to sell their business for?
Yeah, so look, I think as a business owner, you tend to trim your sale either for growth or for margin. It's hard to have high margin, high growth, right? So most people acquiring businesses are going to value your business on, profitability, category you're in, and growth trajectory. And so, the funding and when to sell are quite closely linked. You might decide that you want to scale and grow revenue top line by launching new products, injecting cash flow into the business. And then once you've got your traction, you start trimming back and you raise prices, you optimize your advertising, supply chain, all the levers you can pull, and you trim back for profitability. So, cash flow is always going to be the growth engine, the biggest growth engine. And then maximizing the sale value will be more around profitability, category, and growth trajectory, historical and future growth trajectory or potential in the brand.
Yeah, some great points there. And then Daniel, if you can add your thoughts to that topic too, please.
I mean, really, selling the business is something that is kind of always on the table and then can quickly not be on the table depending on how you've been managing your business. And from the investor side, I think what most people care about is momentum. And so how can you show, whether it's week over week, month over month, year over year, consistent growth, and you're able to show that and paint that picture, it makes it a lot easier of a purchase decision, gives you a lot more leverage. So I think that's, point number one. Point number two, we've already touched on, is unit economics is incredibly important. So the more profitable you are, the more profitable you can make the business, more cash generating you can make the business. It just becomes a lot more accretive to the investor or the acquirer. And I guess the third piece would be, as much as you can think about defensibility or differentiation, what is it that's unique about your brand or your product that no one else can easily replicate? So that could be, do you have a unique distribution channel? Are you, for example, I have a few friends who are influencers in their local market, and they're looking to launch a brand in the health and wellness space. And so they are a competitive advantage. They have a brand that, in their little niche world, no one else can replicate. And so they're going to get a head start out of the gate on distribution. And so I don't know what that is for everyone on the call. Is it something about how you design the product, something about how you've built the community or the brand? That's what's going to help you move out of the standard multiples you'll see in a deal, where if you're kind of a generic product and haven't thought through that, you're just going to get a generic valuation. So if you want to go beyond that, you have to also go beyond with your business and your product.
Yeah, and you're more, just to add to that, you're more defensible. You've got a better chance of lifetime value in your customers and your audiences. So all of that stuff's really powerful in terms of valuations as well. One thing that is probably, I mean, it's all common sense, but if you're trying to copy other people and not differentiating by product, feature, benefit, or story and audience, you're not creating something particular that's going to have value in the long term, and that's going to impact the multiples and the exit values.
Yeah, exactly. Some great points there. So we'll move on to the next topic. So what are the pros and cons, more so for Thrasio and Jim? Pros and cons of selling / exiting your business, because naturally there's that emotional connection, when it comes to the business or the baby that people have launched. So selling it is a difficult decision, but ultimately there's various pros and cons. So if you can just share your insights there, please, Jim.
There's never a con in selling. No, there is. So, the $1 million question for anyone who's got a successful business and is, what if? There's always this kind of thing at night, like, my business is growing, it's making great money, but what if a bomb goes off tomorrow? So I think one of the biggest questions is, like, when's the time to de-risk and take some chips off the table? And that's probably one of the first questions. Then, where are you at in terms of your lifestyle and your capability and where you want to be? Do you want to build a team of 100 people, or, did you start this business to live a lifestyle? And is this business now getting on top of, getting in the way of the original plan was to build the lifestyle. Some people come out of corporate world to be independent and then build this thing, and suddenly they've built their own corporate ship again. So, and then a lot of it is a personal driver. It's like, where are you at? Are you enjoying it? Is it a grind? A lot of people have just found it a bit of a grind. A lot of people are fast starters. They're entrepreneurs. They see the opportunity. They like joining dots, making up the roadmap and getting it going. And once it's a daily kind of operational stuff, they kind of lose interest and they're on to the next thing. So selling is about timing and a number, obviously, but a lot of it's about timing for the individual.
Yeah. And then just to follow up on that, what kind of exit options are available through Thrasio?
Well, let's not make it just about Thrasio. So, you've got different options to sell. You've got, and it's interesting. To take a step back, a year and a half ago, private equity and strategic acquirers were not coming down to the revenues they're coming in now. There's been a real sort of meeting of types of acquirers, which is great for sellers. It gives them more options. So, a strategic acquirer might be, say, Tommy Tippy, massive global brand, kids drinks and stuff, but it's all plastic. And the world's moving on to sustainable. So they now can either build or acquire a new brand. So they're looking at kind of upstarts on Amazon to make a strategic play into more sustainable. That's an example. So strategics are coming in at $10 million revenue brands, which they wouldn't have even looked at 2 or 3 years ago. Private equity, same thing. We were looking at deals that they wouldn't come down to 10, 20, 30 million revenue businesses 2 years ago. Now private equity are coming right down that sort of I had a call yesterday with someone else, and I said it's a bit like the guys are coming with taking their suits off and putting their shell suits and coming down to the streets, and they're getting mixed up in sort of deals that they would have sniffed at a few years ago. So you've got private equity, you've got strategics, you've got family funds who are a bit like private equity, they'll expect you to stay on, and then you've got where Thrasio sit is this kind of pool of a lot of aggregators. The choice of the right person for you depends on what you want. So private equity and strategics will private equity almost certainly will want you to stay on and run the business for 2 to 3 years afterwards. So if you want to leave the business and you have a new project and you're tired, private equity may not be the right choice for you. That said, sometimes they're very compelling deal structures for great final exit numbers. Aggregators, not always, but typically their value proposition to the seller is, we'll put our team and our cash flow behind your brand, we'll accelerate it, we'll give you a share of the profit for a period of 2 or 3 years. And you're pretty much free to sell off into the sunset within months of signing the sale contract. Now, for some people, that's great. They've got another brand, another project, or they just want to go and take some time out. So, who to sell to and why your choice around the right acquirer for you really, is driven by those things. Yeah,
great. So what might be the average deal size? That's just something I'm personally curious about.
For Thrasio?
Yeah.
Well, we get approached by anyone from $1 million with a couple $100,000 in trailing 12 months EBITDA through to $150 million revenues. Increasingly over time, we're doing bigger deals, doing more complex deals. $100 million revenue business tends to be has quite a team and infrastructure behind it. So we're moving more in that direction. But, I think there's probably, my guess is there's 100 aggregators now, So there's an aggregator to suit everyone. Now, I don't think all aggregators are made, have the same capability, but, you know your business as a seller. Just make sure you ask the right questions around whether the acquirer has the ability to run the business as well or better than you. That's what it comes down to fundamentally, because that will drive your final exit value.
Yeah, makes sense. And then quick question for Alexei. So how important is having a good accounting in context to when they're selling a business, managing your business finances in this context? When it comes to
I also would like to take a step back and point out that good accounting practices and good accounting processes are very important, like on the whole journey of growing the business. And I'm pretty sure both Daniel and Jim will agree with myself that without the good financials at hand, you can't navigate. You you don't have the ability to make the good business decisions if you are not sure in your financial data, right? Rubbish in, rubbish out. Like you don't know what products are profitable, you don't know what platforms are profitable, and like you are not sure like what you're not sure if you are hitting the growth rates that you want to hit. You are not sure if you would run out of cash in a few months, and so those that looks like basics, but those are actually the things that are very important, like while you're growing the business. So like I'd say even before you start thinking about whether you need to fund or sell your business, from day zero, invest in proper accounting processes. And I'm not talking about Osome whatsoever at the moment, right? Just like have a proper bookkeeping accounting practices in place, make sure that you are doing the bookkeeping and reconciliation on the regular basis, make sure that you've put in place certain practices and that you follow them, like how do you calculate the how do you acknowledge your revenue, how do you like what do you do with inventory, like how do you track like how much of the inventory you have in every warehouses and stuff, etc., right? So have the proper process in place, move from the Excel sheets. It's all right to have your like business operations based out of Excel sheets like in the beginning, while you are testing the ideas and testing the hypothesis of like what can you sell. But then, like, if you see that the business is growing, have some time to invest in proper tracking and accounting bookkeeping tools, right? So next, once you have your operational setup ready and you have the processes that you follow in terms of accounting and bookkeeping, then the next thing is what you want to have is proper understanding of your profitability of your product that you are selling. If you're selling different SKUs in different markets or different platforms, you want to have clear understanding on how do you allocate certain costs to certain products and to certain platforms, and what is the bottom line, what is the profit that you are making from each of the product on each of the platform, right? From there, you can then make a decision about like where do I invest, where I have opportunity to grow, and like what maybe if like I am selling from the UK to the US, like maybe the logistics kills like the whole my margin, and like I should just like stop selling there unless I see the opportunity to raise prices, right? So again, probably it sound like basic for a lot of the business owners on the call, but like you will be surprised how many business owners that come our way will not care about like those simple things, and like these are the things that you should consider. And then when you come closer to the fundraising and to sale, it becomes even more important, right? Because like Jim can let us know like what are their practices in terms of the due diligence. But if you acquirers that we've talked to, they pointed out that in quite a few instances, what they see that the merchants think that like these are their like growth rates and this is their profitability for their products, but once they get into the proper financial due diligence, they understand that they didn't actually follow proper accounting rules and procedures, and the actual profits for the product they are selling is much lower, and they are surprised by the multiples for the sale are still the same, right? But the EBITDA is much lower than they expected it to be, and then the sale is the sale volume is much lower than they expected it to be, and like everyone is disappointed, and now like no one is happy, right? So I'd say the closer to the point that you want to sell or fundraise, the more important it is to have proper financials in place, and then like it will also allow you to get through the deal quicker if you have proper financials ready for the due diligence. Jim, is it in line with what you see?
Yeah, I think the one most common thing we see is a lot of people use, BI tools like Sellerboard or Managed by Stats or Seller Legend. There's loads of really good tools that, but effectively it's crap in, crap out. And what we find sometimes is that, and it's hard, right? Because supply chain has been such a up and down the last 12 months. But fundamentally, most people have their PPC pretty nailed down. They have their revenues nailed down because that's all automated through the API. The bit that's manual is their cost of goods. And cost of goods is where we find people are less clear on their actual landed cost in Amazon or whatever channel they're on. And that has a massive impact on EBITDA. If you're out by sort of 10% on your landed cost, that just throws all your accounts out. And so more often than not, the weak link in the chain around people's reporting and perceived EBITDA is that line around cost of goods. Everything else it tends to be pretty locked in, and a lot of it's automated now with these tools.
Yeah, agreed. And then I suppose one of the age-old quotes that I have seen, the difference between something good and something great is attention to detail. So naturally, I suppose, Alexei, to summarize some of the things you're saying is those things may not seem as important initially, but they're fundamental when it comes to selling or getting investment. So it is what it is, I suppose, and it's crucial. So,
yeah, let me jump in here, because like what Jim said is very actually interesting about the cost of goods sold part, and that's actually one of the things that is also most frequently missed by the merchant that we work with, right? So when they're coming our way. So I'll just take this opportunity to advertise Osome a little bit, and ask that if you don't have a proper accounting, you're not sure that your tracking of cost of goods sold is properly done and understood, then like feel free to come over to us. We will make sure that it is in line with the accounting practices.
Brilliant. Thank you, Alexei. And then one other thing, guys, thanks for all the questions that are coming in. Really happy to see that. And we'll endeavor to answer as many questions as possible as we reach towards the end of the webinar. So moving on to the fundraising aspect for your e-commerce business. So Daniel, can you share some pros and cons when it comes to getting investment for your business, for your businesses?
Yeah, I mean, I think the only con in my view is if you don't match the cost of the capital to what you're using it for. Other than that, obviously, every business owner and founder knows that cash is what drives the business. And in my view, fundraising to me is all encompassing of what we talked about at the beginning. Obviously, customer financing, you should always do. That means you're just selling stuff. So just do that as much as possible indefinitely, and you'll be fine. When you think about your options, I would categorize in three different options. You have debt, traditional bank debt, bank loans, term loans, revolving lines of credit. You have revenue-based financing, which is a variant of that, but the repayment mechanism is a little bit different. And then you have equity, and then equity is then subdivided into angels, private equity, venture, so on and so forth. So if we go through the list, when you think about debt, pros of debt, especially when you're going to, if you're a larger, more established business, you're probably able to get slightly lower costs of capital relative to the other options. The con is some type of security. So either on the early stage, you're personally guaranteeing it. On the later stage, you are putting up your assets. And in the event of a default or things not going to plan, they get first rights to everything before you see anything and your equity investors see anything. So that's the trade-off of just security in the downside scenario. Very few banks will do it completely unsecured if you're getting a minimal sum of cash. With revenue-based financing, advantages there are speed. So us and some of the folks who are in this space can provide an investment between 20 minutes to 24 hours and can capitalize you very quickly. It's very flexible, and you can kind of turn it on and off as you need it. And then I would say the cons there is just really depending on like what are your other options. I think in some cases we're probably the most cost effective. In other options we might not be the most cost effective. It just depends on what other options you have access to. And then really when you think about equity, again, pros there is it's very good. It's like really the only source of capital for very risky investments. So a bank and even for us, we won't invest into businesses that aren't generating revenue. So we're just not an option if you're below 6 months or you haven't sold a dime of anything. Equity is perfect for that. So the pro of equity is they will invest in the things that do not exist and help you create it. The con of it is the cost of capital for equity is incredibly high. So let us go back to that example. If you look at a traditional venture investor, typically a fund, like a really good fund, is probably returning, call it 3x on whatever they've raised from their LPs. So that's your cost of capital. That basically says, if I took $1 million and I did my job and I made my investor happy, I'm giving them $3 million, $4 million bucks. So my cost of capital is 300%. And no one really thinks about it that way. And that's really the cost of equity, is that's money that's not going into your pocket. And again, there's nothing wrong with it if you deploy that on things that could generate a greater than 3x return. Did you hire an executive? Did you expand to a new market? Are you putting this 3x cost of capital into things that can generate 4, 5, 6, 10x return for you as the founder? That's how I think about that. So I'd say I would look at fundraising. I would look at each fundraising option and the pros and cons of that in isolation to what is it exactly you are using this capital for? What did it cost you? And what's the return you think you can get out of it?
Yeah, perfect. And then just to kind of probe a little deeper, I see in context to e-commerce, is that something for Clearco that is a key area when it comes to helping e-commerce sellers funding their businesses?
Could you share a bit more about what you think would be helpful to talk about?
So essentially, when it comes to e-commerce businesses, is that something, because I see on Clearco's side, that's a key strategic move to be in the e-commerce space. What attracted you or Clearco to invest in the e-commerce space?
Yeah, I mean, we think e-commerce is the future of entrepreneurship, really. If you're starting a business today, like, it's literally probably one of the easiest, starting a business is not easy. So let me caveat that. But in the scheme of all the different types of businesses you could start, we think most entrepreneurs tomorrow will start in e-commerce because, we wouldn't fund necessarily drop shipping businesses, but like, that's like if you're in school and, I've always wanted to be an entrepreneur, you can start a Shopify store or drop ship on Amazon pretty easily. And we're super excited about that because we think that's where the futures of creators will be. And, we think and when you look at that asset class, a lot of these businesses have very good return profiles and very predictable return profiles. If I have an asset that say I put in this amount of money, they're going to invest into the ads, they're going to get this return on ad spend and grow at this rate. And that's so predictable. Like, that's actually a quite safe investment in the scheme of things I could put my money into. And then there's a huge gap because it's such a great investment opportunity. And there's not a lot of funding options for these types of businesses. We thought, like, this is crazy. How is there no one in this space? And so that's why we pioneered this and built out, kind of one of the first products for revenue-based financing for this types of businesses. And, now we're happy to see founders have a ton of different options. But really outside of that, we help our entrepreneurs navigate all different parts of this, whether they're looking to exit. Can we help introduce them to folks like Jim and his team or other acquirers that are looking to buy their businesses? Are you looking to raise equity? We have a whole network of venture investors that look at a lot of our portfolio companies. And there are some who are great venture-backed companies, and we're happy for them to graduate to that. We have partnerships with various boutique lenders or more established lenders like Silicon Valley Bank, as an example, where we're happy to graduate our companies to those financial products when it makes sense, where cost of capital might be a little bit lower. You're getting longer term capital, larger amounts. At the end of the day, we really care about optimizing what's going to be most helpful to the founder. And the part we're just most confident in is we are probably the most helpful for a business that is looking to scale, that needs capital for marketing and inventory. Use us very specifically for that. And then everything else, you have a whole bunch of options, and we're happy to help you discover all of them.
Great. Just a follow-up question on that. So let's say once you've got your investment, what level of involvement does Clearco keep within the busince?
I mean, it's really up to the founder how much help they want. We assign you someone directly on our team who's your one-to-one contact. Some of our founders are just purely here for capital, but we have a lot of services where, short on how we actually make our investment decisions. It starts by connecting your Shopify store or Amazon account, and we use that to underwrite all of our investments. And because of that, we have all this data to then help make additional recommendations to you. So for example, if we notice that your customer acquisition costs are below average, we have partners that we can introduce you to who can help you improve that. Or we have other technology apps or things where you might get discounts or special deals where you're kind of accessing it through our portfolio. We've tried to systematize and automate and scale all the things you would look for in a traditional investor. But we've built it in such a way that we can do it for now 5,500 companies, probably be at 6,000 by the end of the year or something like that. That's how we help outside of capital. It's can we help you raise money? Can we help you find partners? Can we help you sell through our network or some of the other kind of automations we've done through our AI matching algorithms?
Great. There's a lot going on, and essentially, I think what's great is it's not just the money aspect in terms of fundraising, all the different benefits attached to helping founders really utilize it well and grow the business. Moving on to the next thing that we wanted to discuss whilst you're here, Daniel, is success stories or pitfalls to avoid when it comes to fundraising. Some success stories that you come across and some kind of pitfalls that you've seen that the guys on the who have joined us today can look to learn from.
I mean, I'll start with pitfalls. I think that's like a bit more general. Is really if you try to fundraise at a point where you've not timed it properly, so you're trying to basically don't try to raise money when you desperately need money, because then you're not going to have a lot of options. And fundraise. So taking Clearco aside, our funding model is pretty straightforward. You in 10,000 a month in turnover. You have 6 months of history. I can't promise what the specific offer or investment will be, but there will always be capital available for businesses that are, in a decent shape and are growing and showing growth. And so it's a pretty wide range of e-commerce and businesses will invest into. When you think about banks or equity, a lot of those are very relationship driven. And so as much as you have this job of running your business, you have another job of maintaining those relationships. And you can really think about this as it's like an enterprise sale. What you're doing is you're selling someone in an equity scenario a piece of your company. And so that's a long sales process. And you need to maintain those relationships, make sure they like you, make sure you like them. And it might take a year or 2 or 5 or 10 before you ever actually do a deal with someone. And so you need to start building those relationships today if you feel like that's a path you want to pursue. And so a pitfall is really like not thinking through that, not realizing that's something you have to start sooner rather than later for kind of equity style things. But going back to, if you're a business that has 3 months of cash in the bank and are going to go over a cliff, you're not going to raise a lot of money. It's just like I put it back to you, like, would you invest money if you saw a business that wasn't yours with that situation? Probably not. Or if it did, you would charge an insane cost of capital because it's so risky. So try to get well ahead of that. And that's what Alexi was talking about before. That's where having your financials in order, and whether that is, I don't mean audited financials. It's just like, can you at least have a spreadsheet that just shows you your money in, money out, and how much runway you have, and some rough sense of unit economics. And until you are profitable, the only thing that matters is your runway. So how many months of life do you have left in your company before it falls off a cliff? And how do you continue to extend the runway, or ideally become profitable where you have infinite life? And then you don't need anyone's money and you can just operate on your own. And so, the converse of that is success stories. Like, I can talk specifically of when we raised our round with my last company. We were a profitable business generating cash. We had a few million in the bank, and that made it a lot easier to raise money, because it's like, oh, you could give us a few $1 million, but I already have a few $1 million in the bank. So it's like, it has to be a compelling opportunity for us to want to work with you to do that. So the success stories always come from negotiating from a position of strength, whether that's cash in the bank, insane growth and momentum. Those are the types of things I would look for.
Brilliant. Thanks for sharing that, Daniel. And then Jim, similar question in terms of success stories and pitfalls to avoid in the context of selling your business.
In the context of selling?
Yeah.
I think that what I see quite often is a big focus on the top line number, and there's a bit of an obsession with how much have I sold, at the expense sometimes of margin. So in software businesses, valuations are slightly different, and you get multiples of revenue in bigger organizations. But the market, I think, with our audience today, most people are going to get their business valued on their trailing 12 months EBITDA or STE. And so if you've got a business that's doing 20 million at 10% EBITDA, the value is the same as a business doing half the amount of revenue and double the profit. And what I often see is everyone is obsessed with that top line number. They want to show 10 million in revenue. But, if you can't show, and this links into finance as well. If you look at an aggregator, aggregators are borrowing money like anyone else. That's, the cash is borrowed, you deploy it, you get a return on that capital, and hopefully it's much better than the cost of the capital, right? So everyone's playing the same game. So, if you're looking to buy a business that's delivering 8% EBITDA and your cost of capital is 8%, that's not a particularly attractive proposition to an aggregator or anyone buying who's had to borrow money to make that acquisition. So, short answer is, really look at supply chain costs. It's all about driving all the levers you can drive around advertising, supply chain, cost of goods, shipping, which is obviously difficult for everyone at the moment, and just try and keep that margin as near as you can to 20% when all is done.
Yeah, great. And then finally, Alexei, I guess more so on our Osome side, the pitfalls that accountants or accounting software can help avoid. What would be your perspective on this topic?
Just echoing Jim again, like that's 100% one of the biggest pitfalls that we see on our site is merchants not thinking about the financial health of the business, right? Like you are driving revenue and like you don't track really in a proper way cost of goods sold. You don't know like how, like what is your margin. It looks like that you have money in the bank account, and that would mean for you that yep, I'm probably doing all right. Right, but then like what you got to do actually is dig deeper in terms of like what is your unit economics, like what are your margin for each of the product, each of the channels that you are using, and then like from there understand where you are, how healthy is your business, and then like this will also like help you out with then potential buyers to assess the value of your business much quicker, and their assessment will be much more in line with your expectations.
Yeah, just to add to that, something that's really common as well is, and I was guilty of this myself, when you have your brand and you're launching new products, a lot of the time, it's 80% of the revenue comes across 20% of your products or services. But as the creator of those products, you're loath, after the sweat and blood you put in, to let something go, even if it doesn't quite make sense. And so, if you're thinking about selling, you'll be much more attractive if you've got a highly optimized business, and just think about really brutally cutting off that sort of 80% that's only delivering 20% of the sales, because that frees up time, money, team. It can make a big difference, and it makes the business much more valuable to buy as well. Because when you buy a business that's really performing well with less complication, it's a lot easier to migrate and take over and accelerate. So those are the things that people are looking at when they're trying to work out whether your business is a nice target for them. And in turn, there's questions around multiples. The holy grail for everyone is getting the best exit value. And if multiple is the driver of that, multiples are driven by category, margin. Is it another kind of marketplace product like an Amazon product or an eBay product, or has it got potential to become a category leading direct to consumer brand globally? And if you've come up with something that's got an audience, talking about Daniel, an audience, a following, a differentiation, if it ticks all of those boxes, you'll get multiples way beyond what you're probably used to hearing when you talk about how much can I sell my business for. So, focus on margin, focus on differentiation, focus on a brand story, focus on an audience, all the stuff we talked about today. And that's how you're going to get a business that's really attractive and give you a great exit number.
Brilliant. Thanks for that, Jim and Alexei. So that kind of takes us to the end as to the different topics we've discussed. So thanks a lot to all our speakers for sharing the valuable insights that allows us, not to worry guys, to answer the questions that have been put out there. I think one of the key ones would be, what are your methods for forecasting cash flow requirements and scenario analysis in an FBA business? Who wants to take that? Daniel, do you want to take that first?
I mean,
runs the cover.
Yeah, when you think about any e-commerce business, your biggest cash flow hit's probably inventory. So I'd say it starts with that. What's your inventory requirement? What's the timing of that? That's what's going to drive 90% of your cash flow requirements. Outside of that, it's like team and marketing costs and all that, but that's a bit more of a throttle. But inventory, you probably buy it 2-3 times a year. So that's, don't screw that part up.
And Alexei, anything to add after that?
Yeah, I agree with that. With regards to cash flow, start with something simple and easy, just to at least to see the big picture, right? So as Daniel said, you probably know your cost of your team, your office, your fixed costs, right? And then like you have the projections probably for the growth of the sales, and then like your lead times, the like how much does it cost? Well, again, if if you listen to us before and you've put in place proper like accounting practices, then you probably know the cost of goods sold, right? And then you will be able to just like approximate your cost of the inventory going forward, and that would be your like preliminary, your base scenario for the cash flow going forward. And you will probably see that if then like you basically make the scenario analysis, right? What if I invest more in the advertising? A, do I have enough cash to invest more in the advertising? And B, how much more inventory do I need? And do I have cash at hand like to cover this orders for this inventory? Right, and then like in this way that like you'll have your base scenario, and then you'll have your say positive scenario where your advertisement channels will give you more sales, and then obviously more cash will be needed to cover up the increased inventory. And then you see if you have the access to this capital, and or if you have options to, if you're already like beyond 6 months, as Daniel said, and beyond 10,000 pounds a month of sales, that you will be able to apply for funding with our great partners.
Yeah, and just one thing to add to that is, cash flow cycle. Like, the quicker you can go from order to on the shelf for the product, the shorter the cash flow cycle, and therefore the less cash flow you need to grow. So, the other thing I see quite a lot, people are like, I need to raise cash, which is often the case. But if you optimize your supply chain for cash flow cycles, you need less cash flow to grow at the same speed. And it's a bit like the revenue versus profit thing, really focus on cash flow cycle, work with your supply chain. How can you shorten the time from purchase order to on shelf? And then obviously, inventory streamlining. But cash flow cycle is a massive one, because the better you are with the cash flow efficiency on that cycle, the less cash flow you actually need to grow, because you're turning the money more efficiently.
Yeah, some great points there. So next question from Zane: how would you value an e-commerce business if it's already up for sale? Jim, do you want to start with that?
How do we value it?
If it's a business that's already up for sale.
I don't know if ask me the question in a different way. So if it's already up for sale, so if we're coming to it and they're talking to somebody, I can answer how we might look at valuing a business.
Context that it's already someone's perhaps made an offer, I suppose, and does that have like an impact as to how you would value that specific business?
Look, I mean, we'll value a business based on a lot of the stuff we've touched upon: category, historical profitability and growth, how we see the future, all the usual drivers for valuation. We'll value it how we value it. If sometimes if you're in a competitive situation, you might bid up a little bit, but we do a really deep dive analysis before we put an offer on the table for someone, and we only offer on 10-20% of the businesses we look at. So when we put an offer in, we're pretty confident that that's about a fair price and a price that we feel is good for both parties.
Yeah, makes sense. Next question from Jaden. Jaden sent quite a few questions. I'll pick one of those. How do you conduct legal due diligence? Daniel, what does Claire could do when it comes to legal due diligence on the business?
I mean, for us, it's a bit of a different structure. So a lot of our investments are quite standardized. It's not legal due diligence. We do what you call a standard AML, anti-money laundering, know your customer, know your business process, which is standard for any kind of investment. If you go to a bank, we follow all the same steps, and that's primarily due diligence. And the other half is financial due diligence. So especially for larger advances, we'll just take a look at what's the liquidity state of the business, and is there sufficient liquidity that the company is in a good cash standing by the end of our term. And so typically we target about a 6-month repayment period for our investments, and we'll do multiple tranches as the company needs it. So that's the extent of it. In the world of a sale, typically a buyer and seller each have their own lawyers, and it's the legal is due diligence is not so much legal as it is what is under the hood of the business. Is everything you're showing me true and accurate? And so that's audited financial statements, access to what essentially you call a data room of all the pieces of the business in one place for someone to look at. The legal component of it is negotiation on legal terms. So, when am I selling? When do I get paid? Under what terms do I get paid? What are the breakage rights in the contract? That's the legal part of it. So I'd separate legal from due diligence because they're separate concepts.
Yeah. Yeah. Jim, would you like to add anything else to what Daniel said?
Yeah, it was probably a good idea to touch on the process end to end. So, if you're thinking about selling your business, you come and talk to someone like me or whoever you're interested in talking to. We will ask, as Alexis talked about, we'll ask you to provide your P&L for the last 3 years. If that all looks positive, typically we will then reconstruct. And other companies do this in Diligence. We did it before Diligence, but we'll reconstruct the P&L. And then we'll talk you through it. We'll make an offer, or we'll say, look, this business isn't right for us, and here's what we found. And quite often we find stuff that's useful for the seller, even if we don't end up doing a deal. If we get to the point we had to signing a term sheet or an LOI, at that point, you're basically shaking hands, high level, that I'm going to pay you this much money for your business based on everything you've shown me in your P&L being accurate. And you sign it, and no one's obliged to anything now. Then you pretty much shaking hands, and you're going to go into diligence. Diligence, then, as Daniel says, is all about. It's not the fun bit. We're pulling in purchase orders, accounts, bank statements, credit cards, and all that, and we're verifying everything in the deal structure is true and accurate. And that takes a week, 2 weeks, 3 weeks, depending on how responsive both sides are. Then it gets a bit more interesting, and you start looking at supply chain. How can you scale? Can your current suppliers grow how we want to grow? The marketing team start evaluating your marketing strategy, spend optimization, and you get more into sort of the transition of ownership and how to grow the business. But very simple. You talk to sellers, you agree a deal in principle, you sign a term sheet, you go into diligence, and providing diligence goes well, you sign an asset purchase agreement or a share purchase agreement. At that point, but the business ownership changes hands. So one thing that I think is worth mentioning for people thinking about selling their business right now, it's quite a hot market, and there's loads of people looking to buy, and it's driving not great behavior. Specifically, when you sign a term sheet, you are committing to go off the market and be exclusive with that acquirer for 60 days or 90 days typically. So what everyone is desperate to do who's out there buying businesses is to give you these incredibly sexy term sheets and letters of intent that are insane, but you can't help but go, oh, maybe. And it's a bit like the estate agent or the real estate broker comes to your house, overvalues it, and it's an insane valuation, but you can't help but think, who knows, maybe they're right. And the consequence of that is you go into diligence, which is a pretty painful and distracting process, and the acquirer either walks away or renegotiates down on what you thought you were going to get. And it's an unpleasant experience. So, coming back to why we're all here, a bit of advice: if you're thinking about selling your business, make sure you're watching the person before they give you a term sheet to make sure they really know your business. Because if they're giving a really too good to be true sounding offer and they haven't even really looked under the hood, you know the answer to that. It's not going to go through diligence. So, make sure they're really doing some good diligence before term sheet, because 30-50% of deals are falling through because of this behavior at the moment.
Yeah, some great points. Final question, just to probe a bit deeper in context to financial documents. What are the simple things people need to have in order in place to have them being ready to sell or get fundraising?
Well, to sell quickly, just touching on Alex's point, if you've got your trailing 3 years monthly P&L in a reasonably good order, that allows you to come to the table and go, look, here's what I've got. And we can look at the numbers, then we can look at the category, and we can look at all the stuff that our team gets that we can do with that. But the foundation is, do the numbers look great? That's where it starts from the valuation for acquisition.
Got it. And then question to you then, Daniel, as to the financials, as to types of documents, the fundamentals that have to be in place as and when people reach out for investing.
Very simple. It's 3 financial statements: income statement, balance sheet, cash flow statement, for as many years back as you can afford to do. And the better that's in order, the easier it is. The more leverage you'll have with the seller, the better, or the buyer, sorry, is that the better you know your numbers, the more you can talk to it, the more your stuff, you can speak more confidently to a buyer. If you don't have this stuff together, you're just going to be, people run circles around you of pushing back on this and that and poking holes in everything. If you don't have answers, then you're either just going to eat it or choose not to sell and fix it. So.
Got it. And then I guess Alex says, you reiterated before as to the accounting aspect is kind of fundamental when it comes to getting your books in order to get either or option to help businesses either sell or get funding.
Yeah, I just like love the fact that both Clerco and Trazo point out to the necessity of having the good, proper financials in order. That means that we are also helping out the businesses a little bit on their way to the dream.
Brilliant. And then thank you guys for great knowledge that everyone shared today, and thank you obviously to everyone who's attended. That you spent time with us today. So a massive thanks to the community that has joined us today. So just go to closing remarks. Jim, if you want to just leave your final thoughts.
Closing remarks. It's a good time to sell. And obviously I'm going to say that, but multiples have probably doubled in the last 9 months. I think anyone operating now in e-commerce, especially if they're bringing stuff in from China, they're under pressure in terms of supply chain. Advertising costs are going up. Raw materials are going up in Asia. It's not an easy time to be operating, and if anyone's listening, they'll know if that's them. And if you're feeling like that, it could be a good time to think about selling. That's it.
Brilliant. And then Daniel, if you can go next.
I think.
Closing remarks. Sorry, go ahead.
Yeah, no, I think on our end, we're here to support founders in whatever way possible. So, very specifically, if you're looking for support on inventory or investing to grow your business through marketing, that's what we're built here to do. We've deployed 2 billion pounds and counting in this world. So I think the link Sophie had already dropped into the chat, but also shoot me an email. It's daniel.r@clear.co, and I'll put it in the chat as well, and would be happy to help if that's of use to anyone on the call.
Brilliant. Thank you, Daniel. And then Alexei, if you can share your closing remark.
I just wanted to say thank you to Google yourself, to Jim and Daniel for what I thought was a very interesting conversation. It looks by the questions in our chat and polls like our viewers also like the content. And yeah, I just wanted to wish all the success to the entrepreneurs, and always remind myself that it's a great inspiration to build a business that help out someone who's doing like something out of nothing. It's great to be servicing the entrepreneurs, and it's great that more and more you're starting your own businesses.
Brilliant. So thank you, everyone. Thank you, Daniel and Clerco, for joining today. Thank you to Jim and Thrasio for joining, and Alexei from Osome. And most importantly, thank you to everyone that's attended today. All the recordings will be sent to everyone by email. Any questions that we didn't sadly get to answer, we will respond by email. But wishing everyone a great Q4, a great few months ahead. And whatever you need from us, we'll drop all the relevant details, and wishing everyone a great day and week ahead.